I'm Peter White. Welcome to the Inside Network. Welcome to another edition of INDepth. I'm Peter White, and my guest today is Nick Langley, ClearBridge Investments Portfolio Manager. And we're looking at the market outlook for global listed infrastructure. Nick, welcome.
Thanks, Peter.
Nick, you've just rebranded from Rare to ClearBridge. Rare was synonymous with infrastructure. Can you talk us through the rebranding, the how and the why?
Yeah, sure, Peter. In 2019, we as Rare announced an integration with ClearBridge Investments out of New York. They're a much larger firm, but it was about getting scale to the combined businesses. Obviously, back then we're all owned by Legg Mason, now Franklin Templeton. What they gave us was processes, procedures, policies. What we gave them was some international exposure. What our clients got out of it was a follow-the-sun trading model, much lower buy-sell spreads across the funds and so on. And then last year, we rebranded overseas in the US and in Europe to ClearBridge, and we followed that on into Australia this year. Importantly, same people, same process, same approach, still dedicated to infrastructure and still autonomous decision-making around the investment side. It's just that we now have a scale organisation sitting behind us.
Looking forward, what's your expectations for performance in the next 12 to 24 months, given where the world is, new Biden administration, problems in China though? What's your feeling?
Listen, we feel very confident in the forward-looking profile from here. And the reason for that is, we do think inflation is going to be contained. If it does break out, infrastructure is a natural hedge to it anyway. We do think bond yields are going to be constrained because, central banks are going to keep a lid on those for now. We've got great tailwinds in the sector in terms of public policy support, spending on infrastructure across renewables, across climate change, across electric vehicles and the like. And at this stage, we've got pretty cheap valuations relative to history and relative to the rest of the market, and real confidence that we're going to see the earnings coming through and that uplift in earnings and cash flows and in dividends. So on that basis, we feel great about where the sector is positioned today.
And what about the Biden infrastructure plan, so-called maybe? Trump talked a game for a while, but is it going to happen, do you think, this time around?
Listen, I think it will. Even back in the Trump administration days, and listen, they were talking about spending $250 billion at the federal level to stimulate in total $1.25 trillion of spending, so kind of 5 to 1 in terms of government spend to actual spend on assets. That had bipartisan support, just Trump ran out of time to get to it. We think Biden's going to front end that. It's really important for the recovery of the US as an economy. It's really important to kickstart his commitments to climate change, to renewable energy, to getting to decarbonising the US economy. So, we think Biden will get into that pretty quick smart, and we think it will end up being substantially greater than $2 trillion in terms of the amount of capital ploughed into infrastructure, because the government will spend some money, but on the basis that they can stimulate the private sector to spend even more.
So how does your business work into that? There'll be much more listed infrastructure opportunities?
So we think across a range of areas. So, if you take the utilities, for example, electric utilities are going to get a kick from greater spending on renewable energy, from the build out of electric vehicle charging infrastructure, which requires a lot of poles and wires work in the base utilities, from building more what they call grid resilience. So as climate change comes through, the weather is more volatile, we need to build our grids so that they can increase the reliability of the grids and less minutes off supply. And that costs a lot of money. All of that goes into the asset base of the companies, and the regulators are providing a regulated return. So as that asset base grows with those various tailwinds, earnings are going to grow, cash flows are going to grow, and dividends are going to grow. So that's a great thing for the utility companies. In the water space, more than 75% of the US water networks are owned by municipals and governments. And so, we see private sector capital playing a much bigger part in that, and that will come through in the listed market. It's quite small today. It's only $50 billion market cap, but there are a couple of big players that will begin to hoover up some of these smaller water networks. Biden's also got a real push on the communication front. So, he wants all of the US to have access to 5G broadband. That means more wireless towers. It means on the existing towers, there'll be more equipment. Therefore, the Verizons, the AT&Ts of the world need to rent more space on those towers from SBA Communications, from American Tower, from Crown Castle. So we see that space getting a real kick along. And then finally, in the rail area, it's really the greener mode of transport for that long haul transport. So there's a push by the Biden administration to electrify more of the rail network in the US, freight and passenger, and so we see a real benefit there coming through and lower operating costs over time for the freight rail companies.
Do you see more activity by existing companies or a whole raft of new companies entering the boards, or a bit of both?
Good question. We think it'll be predominantly weighted towards existing companies. They are the ones that have the shovel-ready projects. They are the ones that have the access to capital to start building these projects immediately. And so we think a lot of that increase in asset base is going to come from the existing listed companies.
What are the major threats and risks you see to this rather rosy scenario that you're painting?
Yeah, so I mentioned inflation before. If we get a sharp spike in inflation, that would be problematic because it would push bond yields higher.
Which not many people are predicting, though, are they?
Not many people are predicting it. It is a scenario that we run through our models, and we're cognizant of what that would do for the portfolio. If we had an economy that ran very hot, then people would be worried about more structural inflation coming through. Again, there's not many people that believe that we're going to blow through all of the output gaps and so on. So we think most of those risks are pretty well contained, particularly given valuations are pretty cheap at the moment. Across particularly the utilities and a number of the infrastructure sectors. And so we're in a situation where we've got cheap valuations, we've got huge high confidence in the earnings growth profile for the companies coming through, and a high predictability and transparency to those earnings profiles, which will lead to higher earnings, higher cash flows, higher dividends.
For the benefit of advisors and prospective investors, can you maybe just outline briefly the different funds you have in the marketplace and their different risk profiles and different assumptions behind them?
Sure. Let's start with the value fund, which is the balanced fund. And when I say balanced, I mean it's looking for a balance of capital gains and income over a full cycle, obviously from global infrastructure stocks. And so that's really a portfolio built on total return expectations, and the bulk of those returns will come through from capital gains. We then also run an income-focused strategy, and that tends to give up a little bit of the capital gains over time to target more upfront income or running yield for investors. Both of those funds will have a high single-digit, low double-digit return target. But interestingly, once you take the different profiles of balance versus income, on the balanced fund, you tend to get more of a balance between utility companies, which are a little more defensive, have higher income, and the infrastructure names, which carry a bit of GDP sensitivity. And then on the income strategy, because it needs more of that income, that'll have a higher weighting towards the utilities, which actually makes it a more defensive fund, and a lower weighting towards the infrastructure names, the GDP sensitivity. So investors can really think about it as defensive higher income, balanced higher growth.
You're quite optimistic about the immediate future. Can you compare the space we're in now compared to other times where you've been particularly excited about the opportunities for infrastructure? What are similar periods in time in the last, say, 50 years?
Yeah, listen, I think coming out of the GFC is a similar time as well as the period immediately after the European debt crisis. And what we had seen in those occasions was a real sell-off in bond yields, some fiscal stimulus from governments, monetary stimulus hitting markets as well, and we had a period of high growth, low inflation, and low bond yields. So I see that sort of environment, which is very positive for infrastructure. But I also see, which is different, some real public policy tailwinds, which is going to drive infrastructure spending for at least the next decade, if not a couple of decades. And there, we've talked a little about the climate change initiatives. We've talked about electric vehicles, the push towards more renewable energy and grid resilience, and so on. We've got a whole series of those themes which are really underpinning the growth in the underlying asset bases of the companies. And as that occurs, the regulators are recognising that the companies need to earn, an appropriate return. We're not talking super profits or anything like that, but earn an appropriate return, which frankly is pretty attractive in today's environment. And so, that matched with today's pretty good valuation environment, we expect to see decent returns for investors over the coming few years.
In terms of geographies, is America the most exciting market at the moment, or is that just because we're post-election?
Listen, it is exciting. We've been overweight to the US since the middle of last year. And part of that has been, election. Part of that has been a recognition that, the infrastructure in the US is pretty poor on the whole, and there's a lot of pent-up spending that's required, and that will drive, solid earnings, growing cash flows and dividends. For most of the companies in the US. So we like that. We like the renewable thematic in Europe. There's also a real push towards green infrastructure in Europe, which is attractive. There's actually less that's attractive in sort of Asia Pac and Australia in particular than we've seen in history. So we're lower weight there, higher in the US and about even in Europe.
Nick Langley, thanks for talking to us today.
My pleasure.